This is an Uncovered Japan Company research report on Ichigo, ticker 2337. Ichigo is not a conventional developer. It renovates and repositions existing Japanese buildings, then combines property gains with recurring income from asset management, hotels, and clean energy. That unusual mix has produced a mid-teens return on equity. But it is financed with substantial debt, so the central question is whether recurring income can outrun the rising cost of money. At the report date, Ichigo traded on 10.3 times forward earnings and 1.43 times book value. Its FY 2026 ROE was 14.3%, close to management's 15% plus target. That quality comes with a clear balance sheet trade-off, an equity ratio of roughly 27% and around 276 billion yen of interest-bearing debt. The valuation is modestly below the broad real estate sector, but the discount is not a free lunch. The word to understand is shinshiku. Rather than build new towers, Ichigo buys aging properties, renovates and retenants them, and either holds them for income or sells them into funds it manages. That core is joined by a capital-light property product business, hotels, and a 188-megawatt solar and wind portfolio. The point is not a collection of unrelated assets. It is a way of turning a building upgrade into several potential streams of cash flow. Ichigo's potentially durable advantage is vertical integration. It sources a property, applies its value-add craft, leases or sells the improved asset, and can place it with its own J-REITs or private funds. That internal exit channel reduces the usual risk of finding a buyer at the right moment. It also means one building can create a sale gain and then an ongoing management fee. The limitation is equally important. This loop still depends on property markets, deal sourcing, and access to capital. The financial record is real. From FY 2022 through FY 2026, revenue rose from 56.9 billion yen to 92.7 billion, while operating profit roughly doubled from 10 billion to 20.4 billion. That is about a 19% annual compound rate for operating profit. And FY 2026 was a record year, with a 22% operating margin. The rising mix of higher margin businesses, especially asset management, hotels, and clean energy, has helped widen group profitability. There is an accounting wrinkle that matters. Gains from selling value-add and hotel properties are recorded below ordinary profit, so that headline can understate what those businesses earned. In FY 2025, Ichigo's own all-in operating profit measure, which adds those sale gains back, was 24.9 billion yen versus 16.3 billion of reported operating profit. For this company, the cleaner read is net income and all-in profit, rather than one quarter's ordinary profit headline. The segment mix is deliberate. Asset management is the smallest revenue line, but had a 65.8% operating margin in FY 2025. Hotels earned a 34.9% margin, while clean energy provides long-dated electricity income from 188 megawatts of capacity. Value-add property and hotels provide larger, lumpier gains. Management fees, rent, and power sales provide the steadier base. Diversification helps, but it does not remove exposure to rates and property values. The Ichigo 2030 plan puts hard numbers behind the strategy. ROE above 15%, cash ROE above 18%, and a recurring or stock income ratio above 60%. The ROE target is already close, 14.3% in FY 2026, with FY 2027 guidance implying around 16.6%. The unfinished work is the mix shift. More asset management fees, rent, hotel operating income, and clean energy revenue would make the earnings base steadier and less dependent on property sale timing. Capital returns are unusually explicit for the peer group. Ichigo has not cut its dividend since 2017, raised its dividend on equity floor to 5% or more, and delivered an estimated total payout around 88% in FY 2026. But investors buy that policy alongside a 52.83% controlling shareholder. The stable owner and high payouts can align incentives today, yet minority protection and capital allocation should remain part of the investment checklist. At 10.3 times forward earnings, Ichigo stood near the middle of its own 5-year, 7 to 13 times range. It was roughly 19% below the broad sector PE, but above the median multiple of its closest smaller listed peers. The fair interpretation is nuanced. Ichigo is not a deep value liquidation story. It is a differentiated, higher return real estate operator at a modest sector discount, with the leverage risk clearly embedded in the debate. The report's 3-year scenarios show why sizing the risk matters. Using earnings paths and valuation multiples inside the historical range, the FY 2029 outcomes are 256 yen in the bear case, 568 yen in the base case, and 898 yen in the bull case, compared with a 414 yen reference price. These are scenario outputs, not price targets. The decisive variable is rates. Higher funding costs can compress both profits and property values at once. Ichigo is a more sophisticated business than the simple property company label suggests. Its Shinchiku craft, managed fund exit channel, hotel operations, and clean energy portfolio give it several ways to create value, while its returns policy is notably shareholder-friendly. The condition is financing. The company is deliberately levered, and the cost of Japanese money will determine whether recurring income strengthens the model faster than rates pressure it. That makes Ichigo a research case where business quality and macro risk must be considered together. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.